Good afternoon, everyone, and welcome to today's presentation. The Inside Technician has the pleasure of presenting select webinars to a very select group of traders from time to time in order to help educate you about how to become a better trader. There is few far in between within the overall group of traders worldwide who have the ability to get into the markets and consistently make money and understand that their greatest positional advantage in trading is looking for the best of the best setups and being able to take advantage of those at the right time, at the right place. Real-time trade setups identified is today's subject matter. We're going to cover quite a bit of information in a short period of time. And at the end of the webinar, again, we will open it up for questions within the allotted time that we have to do so. My name is Jeff Killian. I'm the Chief Market Strategist at the Inside Technician. And I want to get right into today's presentation. So let's begin. A lot of traders are not aware, should be aware, that there are specific chart patterns that exist that we want to be interested in trading off of, and specific chart patterns that we want to stay away from until things become more clear. In the case of today's presentation, I want to go back to this area right here, and I want everyone to take a good look at the larger range bars. The volatility here, the range of the bars, the measure of market variability being volatility here as compared to this before the sell-off took place. This type of behavior is something that I'm not interested in touching. I am interested in staying away from this type of setup up and until things become more clear for me and I have a real opportunity to trade. Now, where today is February 25th, 2015, the market is now closed. We are backing it up and until more or less this date here, which is 2/18, at around 2000 hours. New session has just begun, and all this volatility has pretty much exhausted itself for the time being. What I want everyone to see here is how, in time, as we move into the hard right edge, okay, the pattern that exists here, clearly, market net neutral moving sideways will have to put itself out one way or the other. And when it gets out of this channel, there may or may not be a trading opportunity. But first and foremostly, I want to focus in on the actual trading channel that's established because we have a chance to corner the prices and the opportunity to be able to trade in either direction based on what the overall market bias is as compared to the real-time trading setup opportunities. In this case, looking at the chart pattern in isolation first. As you can see, there was a substantial sell-off here. So let's go back and let's take a look at this for a minute here and know that at this time, at 2:16 a.m., on 2/19/2015, after the prices had moved sideways here. Okay, what I see here at this time was a substantial dump that came in from large institutions here, and then gaining back some of the loss that was from here to here, measured out from a certain value that existed within this indicator to a certain value that existed within the indicator here and then again here. Now, the interesting part about this is that when we look at this in an overall fashion, we need to consider the possibilities of what is the trading channel at that time. Here, from a wider perspective, our trading channel could officially be established from here to here, right? Okay, that's easy enough to do. We have a few different data points that are located right here, and then we have two very close in nature right here. I won't get into the numeric values of these levels at this time so that we do not chew up the allotted time that we have for this webinar. Okay, now, at this point, once we know that this has formed itself, as we move into the hard right edge, what we want to do is we want to look at the size of the dump as compared to how far the move went. The dump is way down here, and the prices have only moved down this far, which leads to the possibility in my mind that prices could get through the channel to the downside if they're going to move in that direction all the way down to possibly here on a major 15-minute support level. Now, this is something that is unknown as of yet, and the channel that is established between these data points here and these data points here is Y. So let's do the right thing, and let's come in here, and we'll squeeze it down. The next level to the downside becomes right here. So now the channel is much narrower in range on the top side as compared to what we just had. In this case, let's squeeze it up and look at the next possible data points to choose from on the downside. And what we have is something right here. Okay. However, we already have a penetration below that point, so the new downside channel level is established by these most recent data points right here, these two closes. And this is the way it should be, because the most recent prices, in this case, according to this type of pattern, that have hammered out the most recent two closes here are the data points to use, because the most recent prices take precedence for creating the downside or the upside of the channel, in this case, the downside. Now, the interesting part about this here is that if we look back, we can see that if prices get through these two closing price areas, which are an exact match, and the actual price at the time on the close was 2,093 and 25. That's 2,093 and 25. There may be a possibility for a free and clear move from here all the way down to here, because we have no downside resistance. So once again, we've just come out of this strong volatility here, something that we're not interested in trading whatsoever. These are for the people, or that chart pattern is for the people who are inexperienced and do not know what to stay away from. So we've gotten out of the woods here so far. We have a smaller trading range that's been established now between here, and we're looking to see what's going to happen out of this one way or the other. I mean, I know that we could squeeze this channel down to the here, possibly here or here as well. But the idea behind what I'm referring to right now, if I look at the real opportunities, I want something that has a much larger move. I'm not too interested in taking a long trade and getting above this level right here when I have so much upside resistance that's located here, and then yes, the end goal move would be here, and it's not even 3 points. So if I trade long, I know I'm trading into resistance based on the chart pattern isolation from here, drawn from here, and drawn from here as well. Very simple to see, very straightforward, all based off of the chart pattern in isolation. And additionally, the relative comparison of the price move to the downside as well as the dump that came in, and the recovery so far is only located here. So as we move into the hard right edge, we can see that now the MFI, the money flow index, with a 14-day look back, in this case a 15-minute chart, a 15-minute bar look back, is now much lower as compared to this level. And prices, as this level is relatively close to what this price point is saying, and this price is relatively close to the same level, and this indicator being much lower, it's obvious that prices are still trading in a channel, but on weakness as compared to where prices could be trading if they will fall off. Weakness as compared to here and where they can be if they fall off. Is everybody with me so far? Any raise of hands? Very simple, straightforward approach to chart pattern analysis. Okay, good. Excellent. Okay, please lower your hands. So now at this point, we're moving into the hard right edge again, and we know that if we're going to be short, because our preference is short rather than long, because we have a free and clear move from here to here, no downside resistance, right? Then that's where my eye is getting magnetized towards. I want to see the setup come to me to be short in real time. Okay, here we are, and I know that now the momentum has changed direction from the through that was established here and moving to the upside. So I'm looking at the relative comparison of the strength of this point right here as compared to here, and I want to see what the end result's going to be. Will prices get through the ceiling, or will they find this area here as resistance and trade off of it to the downside? We have a failed try, in this case, to get back to this price level right here. This in isolation is a clear indication as the MFI turns back around to the downside that this is more than likely where prices are going to halt right now in real time, and now a setup is gaining strength in our favor for the setup for the high probability trade to the downside. Now I know based on this price level in isolation right here at 2093.25, and I'll get in here and I'll do this so we can tune it up and we'll be exact in our analysis. By the way, all objective analysis, something that can be examined, a conclusion can be made that is 100% objective, that can be acted on, provides actionable intelligence that can be acted on, factual findings, right, that we can trade off of in real time. So nobody invented the chart pattern besides the market. Nobody invented the indicator formation besides the largest institutions. Some larger than others. At this point, they're all participating in the overnight session. The time is now, according to the chart pattern isolation, 00:45 hours. We're moving into the hard right edge, and we have increased momentum to the downside out of the money flow index. We also have, for those of you who are familiar with a technique that I teach here, the internal trend line that is established from this through to this one here. We're looking for the violation to the downside, which may come at this floor level. That remains to be seen for an additional confirmation. So as we move forward, we can see right now that the MFI has penetrated the upsloping trend line here in real time, but yet the prices are not through the floor level that's been established on the 15-minute chart at 2093 and 25. In fact, they're trading at 2093 and 50, just a tick away from the actual floor. The real value of the majority of indicators, the majority, is their ability to lead, predict future directional prices. We need to look at indicators that are proven, time proven, that have predictive abilities, but with a high degree of accuracy. Now what we're seeing here is the violation of the trend line to the downside, but yet the prices are still holding. In my mind, in a perfect world, I know that I need to be short at 2093, a quarter of a point below the 15-minute level that's established at 2093 and 25. Now the 15-minute floor level, in this case at 2093.25, is the approximated level for the 1-minute chart. It takes 15 minute bars to equal a singular 15-minute bar. So therefore, the 1-minute data points may vary according to where the 15-minute data points are located. In this case, at 20, 93, and 25 for the internal floor level. So I'm going to go with the absolute data point that exists within the 1-minute chart because I know where the 1-minute bars have actually created what you're seeing here. We could have a variance, and I don't want to get in too early, and I don't want to get in too late. I want to get in with the confirmation so that I can make sure that I get to and through the actual floor level with a lot of volume in a slower moving market on a close. In a fast market, possibly I'll have to get in, and I'm either right or wrong, but I'll know that my analysis is correct, and if I get stopped out, it's with a small amount of money placed on a short stop, a close stop, as compared to the entry, and I can get right back in, once again, when more volume comes in and I get the follow-through that I'm expecting. So, in that case, we have the MFI with the leading indication that now the smart money is already taking their positions to be short, have sold into this, and it's a matter of the follow-through. This is the bias. Let's get out of the other two levels that are associated with the upside so we can focus in on what we need to do right here, the hard right edge. Now, at this point, you can see prices still move here, and we're not through the floor yet. But look at the value of the MFI as compared to where it was here on the initial trend line break, and the prices are still contained within the channel. We also have another trend line violation right here. So, with additional downside momentum. It doesn't get much more clear than this, but let's not forget where we began, traders. From beginners to advanced people. There's a wide spectrum of traders in this room today. We have to keep things very simple. We have to keep things very simple where they can become very complicated real quick, and real time. So always stay focused on the larger picture, on the macro as compared to the micro. The micro picture, in this case on a 15-minute chart, is let the setup play itself out. Let the trade come to me. Like I always say, I don't have to prove anything to this market at any time, any place, anywhere. If anybody has to prove anything to anyone, it's the market has to prove to me that it's worthy of my time, my money, my emotional capital. Otherwise, I'm on the sidelines because I don't have to trade. Nobody has ever wiped out their account by staying on the sideline. No one. The time is now 2:15 a.m. Well, now at 3 a.m. Eastern Standard Time, right? The European market is about to open, and the participation is going to be greatly increased, which means that if the market is going to move to the up or the downside, in this case, let them come in. Let them be the follow-through that I need. Let them show me that their participation, the increased amount of contracts that will be traded because of the short increase in participation, will push the prices through this floor that I've been waiting on, and now the trade setup is even better than it's been before, so that I can trade short, and when I'm done, if I get all the way down to here, at this price point, at 2,091.25, and I can make the difference, and I can forget about trading for the rest of the day, period. Walk away and have the ability to do any other thing that I want to do. Yes, let's not forget about the balanced life. This is why this methodology was designed this way. So as we move forward, here we are, and there's your move, bang, from here to here, and even lower, and locked in a profit, and you're done. Now, the unfortunate thing is that most recently, the volatility on the 15-minute charts and the 1-minute chart has been very high. And this is because the market has been trading up into new high territory. Getting up to and through is one of the largest battles that ever exists between medium, small, and the largest of institutions. The largest of institutions like the Goldman Sachs, the George Soros hedge funds, and like-minded individuals who can move prices from one level to another will always be the winners. And the smaller institutions will make the lesser amount of profits, and in many cases wind up losers because they do not have the ability, because they do not have the deepest pockets to actually control how prices move from one level to another. When you're going to be educated as a professional, if there's nothing else that I could teach you today, start with this. Start with the preferred model to learn what to look for. In this case, it's short. It could very well have been long. But this is the case model that we're studying right now within this workshop webinar. Look for low volatility. Volatility, once again, being a measure of market variability. In this case, the 15-minute charts, which are the mother of all time frames, to be analyzed and to trade off of in real time. When the market loosens up, these are the time frames to be studying with the most amount of focus in order to make the most amount of money and walk away. In a tight market, you're going to pick up half a point, maybe 2 times a day. So when the market gets tight, when things are tough to trade, you stay on the sidelines, you study, you practice, you learn, you paper trade. And when the market opens up, that's the time, with the experience that you have behind you, to start trading real money. For those who've been trading a long time, trade more contracts, full knowing that this is the time that you have waited for. The market may be tight as far as I'm concerned, but when I get a trading channel established like this is a gift. And I know that if I get out of this with the right type of setup, in this case to the downside, there's almost no questions asked. I'm going to literally get in here and I'm going to take money out of the market, I'm going to put it in my account, and I'm going to say thank you, and I'm going to get out. Because I know that these are the toughest times to trade. It doesn't sway me. And it can't sway you when you have a tough market to trade. You have to understand that this is the way it is. We have to take what the market can give us. We can't invent anything. The key to longevity, trading as a professional and staying in this business week after week, month after month, and year after year, is your positional advantage. You're not a professional. You're not a prop trader who's working off of the house's money, who's got to produce a certain amount of trades to make money almost on a daily basis and under all the pressure, reporting to superiors. You're an independent trader. You don't have to trade. You don't have to answer to anybody but yourself. And if it means only to yourself, then why not have the best answer? The best answer is that your positional advantage has to be employed. So when you look at yourself in the mirror in the morning, at night, anytime during the day, after trade, you say, I've done the best that I possibly could. I followed the rules. I did everything right. And I stayed on the sidelines. And if I made money today, I did. And if I didn't, well, I got out of that trade as fast as humanly possible because it wasn't in the probabilities for me to make a profit today. And you walk. You can't chase the trade. Okay, out of the as they say in Spanish, sabiduría, the wisdom behind what I've had to say is a very practical, straightforward understanding that this is what we're looking for. It's real simple, people. This is what we're looking for as compared to trying to trade this. As compared to trade, look at the long tails down, long tail up, all of this too. Look at the similarity between this chart pattern and this one. And this one sold off. Not as good, higher highs, right, at the end of it all. But at that time, it was very similar. Okay, back to the chart pattern, the case model that we're studying within this workshop today. Okay, prices hit here, and obviously if you had had additional targets to the downside, which would have been placed ideally on a longer term support level here and then again here, right, you would have had an additional target here. Now the thing about trading out of the channel and to the downside on a breakout is understanding very well the best probabilities are the first move. It's always the way it is, people. In a tight market, you have one chance from here to lock in a profit. Fastest trade possible. This took place within 15 minutes, all the way down to here. And it might have been 2 real-time trades, right? In order to make this happen, we'll get into that in just a minute. But this is what we're referring to here. Free and clear move from here to here, another from here to here. Yeah, there is some internal resistance here, incremental to the downside, but here's your next major support level, and then it becomes here. So this is how to identify, looking at the MFI in isolation, the best possible setup, in this case, to the downside. I'm a better short trader than a long trader. And I think that I'm probably a better short trader because I want to be. It's, the self-fulfilling prophecy or rule that a trader can follow. Because I know that the majority of the time, prices will fall faster than they'll move up. So if I can make more money faster by trading short, that's what I'm going to focus on. I'll prefer to trade short than long on any given session. Let's take a look at a few of the other charts, and then we'll get into 1-minute chart for a minute here. Okay, that's the MFI. Looking at the shorter term, institutional money leaving, selling short. Overnight session comes in, and then basically at the end of it all, with the European session kicking in 2:45, and then at 3 a.m. you have the move, and there's your additional right here. And then also another move to the downside. Again, the first move is the most profitable one out of the channel. Let's take a look at the other indicators once again, and let's look at the CMF. The Chaikin money flow in this case is here. Now, at the time of the actual trade was taken, in real time, you can see that the violation of the floor takes place here. That's static. All the charts will reflect that. And in this case, if we blow up the indicator itself, once again, I'm looking at the relative comparison of the size of the dump as compared to the give back. Here's the level here. Here's the higher level here. So we have an official additional avergence where we don't have a negative divergence, but we do have an avergence, meaning that if for nothing else, we have a confirmation that we have a higher price, higher indicator level, lower price, lower indicator level, but then this becomes complete as soon as this bar opens, right, and moves down. At this time as well, what you also have is an official trend line violation to the downside right here, as connected by the point of origin and the secondary connect point here, right there, as prices get through here. So the turnaround itself and the actual trend line violation is an additional confirmation. More the change in direction to the downside in this case. Looking at another indicator that I want everyone to see to identify the official change in trend, okay, in this case, is the MACD. Lagging indicator. The cross had already taken place from above to below. The official change in trend had been established by the slowest indicator within this trading methodology. Very simple, once again, very straightforward, unobtrusive way to get inside the market, get behind the prices, and take a look at what's really happening before any trade considerations get to the serious level. Okay, so trend officially changed way back here, free and clear from here to here, and we are now clear according to the MACD in isolation in order to be short, because the trend has officially changed. As the trend continues to the downside, the disparity, the difference of distance between the MACD and the signal line increases. Here we have it. So now let's get into the 1-minute chart and take a look at this volatility amplified, spread out, because we have 15 1-minute bars for every singular 15-minute bar within this pattern itself that we had discussed earlier. So here's the pattern itself. Things start to calm down, and let's take a look at it in an amplified view right here. Here it is. There it is. Now it becomes real clear to see that the move we talked about earlier in the sell-off still made money, right? From here to here. Very interesting, isn't it? This, at this point, was the actual floor level of the previous pattern that we saw before the volatility took place. Okay. We also have a target to the downside that's laid out at this level by a base formation here, and that's exactly where prices got, isn't it? Pretty much right there. In here, out there. And as you can see, you have an increase in volume here. In the overnight market, once again, the volume is much less. It doesn't take as much to move the prices. So once again, history repeats itself. Let's see if it repeats itself over here. Here we have the channel that's established right here. The time is now 2:23 on 2:19. 2:23 on 2:19. Okay. Let's spread out this. Remember, people, spread this out so we can see things clearly. Here is something that we do not want to be any part of whatsoever. All program trading, all algorithms that are producing trades, a fight between the smaller and larger institutions. Things settle down, low volatility, right? And looking to get out of that one way or the other. Okay. So here we are in this case, and we're looking to get out of it to the downside. So I need to spread this out. Here's the downside of the channel. Here's the upside. It's connected by all these data points. Remember, we didn't want to touch this because we have clear incremental resistance to the upside, but in the bottom, look at how this chart pattern is interlocked. Look at the clear area here for support, aka price profit target, and then again here at this point, right here. Target 1, target 2, target 3. Is there anything else? Target 4, right here, right? If prices go that far. I don't have time to draw in all these levels and put the numeric values in, okay? So let's cut this out so we can focus on these specific targets that we have here. Okay. All these will be laid out and broadcasted out into the future, into the hard right edge. Let's blow it up more. I want to see if any substantial volume comes in. I'm going to squeeze this chart up. And we move into the future. Spread it out a little more so I can see if any substantial volume comes in. Some here are gap down. That's an early indication of weakness. More volume coming in now, getting closer to the European session opening. See the difference? Nothing here. Something. And there you have it. With only 427 contracts getting through on a close, it starts the entire move off. The larger contract sizing that came in here at this time at 241 on 219 for 3,230 contracts. Incredible, right? Drove the prices all the way down to 2,090 and 50. That's 2,090 and 50 for a trade that never, ever looked back. F6 and the Ninja Trader platform. Let's take a look at this level and let's see if there's any tight relationship between where these prices ended up and any of the 15-minute levels that I had laid out in the past. Before we get into that, anybody who has a calculator could run this. At 2:33 a.m. Eastern Standard on 2/19, that's 0233 hours to be exact, on the close, 2093. Remember that? 2093 was the 15-minute level we talked about before. 2093.25 was the exact level on the 15-minute chart. 2093 was the level that I just stated that I would be in this trade. So even if you got in on the close at 2093, right, in a perfect trade, you got in 2093 and you wrote it all the way down to 2090 and 50 on a 1-minute chart. Let's go back. Okay, you exceeded this target and you have a failed try to get to a lower level right here. A failed try. So what does that mean? It means that if prices do not get to the next level, to the downside, right, you got close on a closing basis. Volume comes in, it's either additional distribution or it's to halt prices at the current level. Sure enough, here's your short-term correction to the upside within an existing downtrend. But this is the bulk of the move that I'm talking about. The very first move, getting out of the channel to the downside in this case, is what you want. The second trade to the downside here on lesser volume is a higher risk category trade. A higher risk category trade. So the best of the best is right out of the box, right down to very close to a price profit target to the downside. In this case, we were there. Okay, so that's an exact match. I would have had this level laid out. Okay, and there we are. So this is actual proof of prices getting down to the expected move. In this case, it's 2090, and the yen being 2093. So that's 3 points in a very short period of time. This is the type of preferred model to learn from, to take with you into the future. And as your skill level increases, you know that the volatility will get greater, and you know that you'll be able to trade it, make maybe less than this, whether long or short, but still lock in a profit. Anybody that's been trading for a long period of time has to go back and study the preferred models that exist within professional trading so that they can learn from that. Learn it right, learn it once, and take that and walk with that and use it for the rest of your trading career. What we have just done is gone through a very, very transparent preferred model set up using the chart pattern first as the decider as to whether or not we will consider taking a trade. In this case, it turned out to be a high probability trade set up to the downside. It was taken by many people who have come through the system here, whether they studied the course material or they've been through the executive mentorship program and studied with me personally. They know how to identify these trades and take them, and they can get up if they're on the U.S. clock and trade this session, or they can do it in the early morning. In this case, the volatility has been light, a lot of overnight sessions. It's been easier to trade than any trading room could ever provide for the daily action. So learning this gives you the ability to move in and out of different times to be trading, and know that this is the preferred setup to be looking for and be trading. And when you're finished, as I always say, book it, close it, forget it, and move on to something else and live a balanced life. This is one of the biggest advantages of this methodology once learned in the right market conditions, so that you can live a balanced life, raise a family, have another life, go work out, do something positive, take a vacation. I know a lot of traders who haven't traded anything, who have a different style, who haven't traded anything in the last few weeks because it's been tough to trade. Okay, so there's your move. Let's get this back down here some, and we're going to open this up to some questions now. All questions, please have them located within the chat area so that we can get through them as quickly as possible. Okay. Chat area is now open, and I'm ready to field whatever questions anyone may have. Okay, there's two areas here, Bill. One is the question area, and one is the actual chat area. Let's use the chat area. Okay, so for the sake of confidentiality, I will stop the recording at this time, and I'll go ahead and unmute some people, and let's see if we can get some of these questions answered verbally. So for those of you who do not want to participate in the questions, all attendees, I want to thank you for being with us today. The Inside Technician is specifically designed to teach the serious trader what he or she needs to know in order to be able to trade the markets as a professional, in this case ES, the S&P 500 E-mini futures, in real time, and be able to also know that, once again, in any trading environment, there are times to be trading, there's times not to be trading. And this is the hallmark of a true professional. This is Jeff Killian, a Chief Market Strategist for the Inside Technician. For any more information regarding what we offer in our educational products venue, please visit theinsidetechnician.com for the course material and the mentorship program.